have the unemployment rate in red, and on the other, government deficits in blue, which is how much more money the government spends than it collects through taxes each year. Now, normally, these two lines move together in really predictable cycles. When the economy is strong and unemployment slow and people have jobs, governments collect more taxes and they spend less money, so deficits shrink. Then, during recessions, the opposite happens. When people lose their jobs, deficits go up as governments step in to support the economy. But notice something strange that started to happen around 2017. Even as unemployment rates went down to historically low levels, the deficit started going up much faster. In fact, today, our yearly deficit is around 6% of GDP. Again, that's double the level that economists usually consider healthy, and that's not good. It's like the government spending money as if we were in the middle of a recession, even though the jobs numbers say that the economy is really strong. And that means we're borrowing at a pace that's normally reserved for economic emergencies. And here's why that matters. The more money we borrow, the more bonds we have to create, and the more the debt piles up. Over time, that makes investors very nervous. And when investors get nervous, as we talked about earlier, the interest rates start to go up. When rates go up, the value of the bonds go down. That's sort of the trap that we're in right now. We're borrowing really heavily, even in good times, which sets us up for some serious trouble as soon as investors lose that confidence. Now let's look at the next slide, which shows another really important piece of this puzzle. Now in this chart, it's comparing that real interest rate to the price of gold. Real interest rates are measured by the interest rate you earn on a bond, typically the 10-year Treasury bond, minus something called the CPI, the Consumer Price Index, which is how economists measure inflation or the rate of growing prices. So real interest rates, again, are 10-year bond rates minus inflation. Now, historically, when real interest rates are high, investors want to buy bonds because you can comfortably earn interest above inflation, keeping the purchasing power of your dollar. But when real interest rates go down to almost zero or even negative, investors start looking for better places to put their money.